Hello traders, welcome to my channel. Today we are going to look at core liquidity concepts, how markets hunt and generate liquidity. We are going to focus on inducement and liquidity engineering. So what is an inducement? An inducement in trading refers to intentional creation of forced setups or traps by institutional players, or what we commonly call smart money. Their purpose is to lure retail traders into the market, then generate liquidity and then move price to the opposite direction. So inducement is very essential in trading because it will help you to dictate where the smart money is likely to push the price. So always wait for an inducement before you take a trade. Here in the price charts, we can see the price is in a bullish trend from this place. We have price break structure here, then goes and form a higher high. Then we see a pullback into the range, into the price range, into our area of interest. So price pulls back. Let's say we have an area of interest on the higher time frame, and we are looking possibly a price move on a lower time frame. We see price move down to this range. When price mitigate our area of interest here, it created a low here, then price push up, then retraces back to this point of interest, then take out this low here before continue moving back. This area is area we refer to as inducement. So there are traders who will be tricked into making an early entry in this area. They believe that price will start moving to their draw on liquidity and possibly take an early start. Price shows that leg of moving up, then retraces back to hit their stop losses before going up. This is an entry inducement, a regular occurrence in the market. So always be very careful in making your entry. Always wait for this type of scenario to occur before you enter a trade. I always wait for this, for price to take out a swing leg when it mitigates my area of interest. It gives you a higher probability entry when you do that. So I urge traders to be conservative when making their entries. Price grab this liquidity and use it to push up, break this high here. Price retraces, we had the sweep here, then move back, and we have the market structure shift. We can say that we are entering in a downtrend. So price continues to this point. Price makes a low here, a high here, a low high here, come down without taking this range here. So we see price push back into this range. What happens here is another inducement, another form of inducement. Price induces some traders into taking position to this area. So some traders who have their take profits targeted, price uses it as an area of inducement. Then come back and take that level to this point. So when price gets to this point, you swap this high here, mitigate possibly your area of interest. Then in this entry area, what do we see? A similar scenario. Price moves down, then moves up to take this liquidity here. We have a sweep here, then before price runs back. Price will not always sweep this level, but your entries, you always have a higher probability of being profitable when you wait for this kind of entry. So when you see it, you wait for the price to take out that price leg there. Then You wait for further confirmations like your SMT, change the state of delivery before you take your entry. So that is how you analyze the market. So price comes here and enter into a range. We have price move to this area, break out of this range. What do we see here? We have a lot of breakout traders who normally trade on breakout. They will think that wow, price has broken out of this range, but what price did is that price broke out of this range, even came down here to take this resistance level. Automatically, some traders who trade range breakout will think that wow, this resistance level has turned into a support. Price came down here, take out this price leg here, then you see price return. So always understand where market is going and what market is doing. Market is always hunting liquidity. If you have this in your back of your mind, you will always be smart in making your entries. Market is always hunting liquidity. So price, what we have here is inducement. So let's look at how price engineer this liquidity. Market only functions with liquidity. So whatever price is doing, it is engineering liquidity. So this liquidity can be classified into low resistance and high resistance liquidity. If we come to this leg here, this price leg here, we have a price pull down this leg. Then we have a breakout structure here. Price has taken liquidity in this area, push back, then push back into this range. We have another price leg here. This liquidity has been taken. We have another leg here. Price goes back and take all this liquidity here. So this area we are looking at that are yet to be dedicated and refers to low resistance liquidity. We have this one here, we have this one here, we have this one here. Then price takes this high. When price takes this high, this area becomes an area of high resistance liquidity. So it is essential to master this because this is what will help you determine your bias. It will what will help you determine your draw on liquidity. Price always draws these areas of low resistance liquidity. Price is always drawing there. If you take your trend line tool and plot this trend line here, you will agree with me that this area is an area of low resistance liquidity and price is always drawing there. So price is engineering liquidity to be drawn. When price is moving, it is engineering liquidity to be drawn. So we can see here, price engineer all this liquidity and came down to take all those liquidity. As we see here, price also engineering liquidity here, this area. Then price came around this liquidity. As we notice, this is a high resistance liquidity. So it is very, very difficult most of the time for price to move around a high resistance liquidity. It does that, but most of the time we focus on low resistance because that is where price is likely to move faster. In the case of a range market, we have mainly both sides of the range being a target of liquidity because there are bulk orders resting below and above on top of the range. So that is where smart money uses to trap a lot of traders because we have liquidity resting on both sides of the range. So you are not sure where the market might likely to push. That is why whenever you see price in the range, you have to wait for a manipulation of that range. Wait for price to break out of that range. Then watch your analysis go on the higher time frame. Then understand the market structure, where the market is likely to draw to, then before you take your trade. So in the case of range, always be mindful of your entries. Before making your entries, always wait for an inducement. Be sure that there is an inducement before you make your entry, because most of the time when there is no inducement, price may use that zone as an inducement to shake off weak traders. Price may use that your zone as an inducement. So always wait for inducement. Always wait for that manipulation to occur before you make your entry. So let's look at a live chart to demonstrate how we can wait for a perfect entry after inducement to get a perfect trade. So we are in a bigger time frame. We can see price has taken this level, and we can see this is a very big displacement. It's a very big displacement. So we are typically in a down trend. And how are we going to take our entry? We wait for price to retrace back, possibly to the equilibrium on this level, then before we can take our entry. Taking our Fibonacci to draw from this range, but do we know if price will draw further? No. So we have to wait for price to close above the recent candle to know if it is a valid pullback. So let's wait and see how it goes. We can see price close above this leg. Price close above this last candle. So we can see that we are in a valid pullback. We are in a valid pullback. We are in a valid pullback. So what do? We take our Fibonacci to drop it here and draw to this range. Then we have fair value gap here. We will consider the ones from our 50% level. I normally draw my area of interest from the 50% level to this area, to the 79% level. That is always be my area of interest. So we will be waiting for price to retrace back into this range before we take a sell. So let's see how it goes. We are waiting for price to at least make a move to this our zone. This is the higher time frame. As you can see, price has swapped liquidity here. So we are expecting price to move up to this range. Price is advancing to this range. Let's move on to our lower time frame as price gets to this range, so that we can spot our entry, spot inducement, then take our entry. This is our lower time frame. So let's see how it goes. Let's see what price does as it enters our area of interest. We have not gotten there yet. Price now enters our zone. Price now enters our zone. First of all, before we get to inducement, what is price doing here? Price is engineering liquidity on these levels. We have this level here. Price has created a low here. Price has created another low here. All these areas are liquidity level that has not been tapped into. Then we have our recent ones, recent price leg, which is here. We have another one here. We have another one here. We have another one here. All these areas are areas of low resistance liquidity. This is an area price is likely to run to. We have a lot of liquidity resting in all these areas. Break of structure. So price is likely to run and take all this level. If you can plot your trend line, take your trend line and plot. For trend line traders, you have trend line traders who expect price to come to this range, this range, then move up. But this is a perfect manipulation. Smart money uses it to manipulate trend traders into thinking that the trend will continue. But at this point in time, we are expecting a reversal of this trend. We are expecting price to come down and take this range. So let's watch for inducement entry. In here, price has made this move downside. Then what are we expecting? We have many traders who will be expecting, who might have been into trade by now, hoping for price to push down. But as a conservative trader, I always wait for price to take out this leg before I make my entry. I always wait for price to come back and show this one before I make an entry. I consider this an inducement. I consider it, if I don't see this kind of manipulation, I do not take my trade. Price may come to this level without any manipulation, then go to the right direction. But if price did not go on to manipulate a level, I do not take that trade. So let's see how it goes. We have a sweep. Price came back to that level and we sweep that range. So when we sweep that range, we have, what do we have here? We have an inverse fair value gap here. We have an inverse fair value gap here. Price closed here. Then, if depending on the kind of trader you are, if you want to wait for price to close this level, take this level, and then reverse to make your entry around here or anywhere, you can do that. But in some cases, I trade when candle price must have taken close below this candle and show me. I see a kind of bullish, a strong bearish candle or bullish candle, a kind of engulfing bar moving downwards. I can take that trade. So be mindful of trade. You don't always win. Just bear that in mind. You don't always win. Price can return back and take it and sweep this level, then make a push before continue backwards. So let's see. Just assume that I'm taking this trade. Where will I put my target? This is where I normally place my target. I normally take 50% of this zone here. This zone here. And my target here, the first area here, then if price comes to this point, I'll close my trade or my target 1 to 2. Let me assume that I place my trade here, place my shorts here, with a stop here. Above this, we have 1:2 already. This is our target 2.5, and here this one is to 3 points. Let's see how this trade plays out. Let's see. You can see we're in a range. We are in a range. As you can see, this is a perfect trade. That is why it is good to wait for an inducement. It is good to wait for an inducement before making your entry. If you have taken trade at this point in the trade, maybe you would have been stopped out at this point. And when price came back and swept this level, swept these levels here, because we have liquidity resting here, we have here, price came back and swept those levels. It gave us a perfect entry. Do not take any trade without first seeing the manipulation. Then target areas of low resistance liquidity. As you can see, price came here and run this range, and possibly go into this range. Normally, if I'm setting my target, I don't normally look at this area. So I normally target the first high, then the mid-range, and leave it. So as you can see, we hit a 1:3.6. 1:3.6, take profits. So if we continue to do this, maybe you see price go on and take all this area and return to this area. But before you can get to that level, price will probably more have reversed and created another swing point. Swing point. You know we are in a lower time frame, so price will align with the higher time frame. Price will not always be moving as fast as possible. It doesn't work like that every time. So price will have to go on, price pulls back before continuing its move. So I will advise you to open your chart and go and backtest this. So whatever entry you are making, always look out for inducement. When you get that inducement, when you get that manipulation, you will be able to take a more better trade.